Amid the Central Bank of Nigeria's tight monetary stance, Nigeria's average prime lending rate climbed to 18.19% in June 2025 from 17.96% in May, even as the Monetary Policy Committee held the benchmark monetary policy rate at a steep 27.50%. The prime lending rate, typically reserved for banks' most credit-worthy clients, such as large corporations, serves as a pricing benchmark for a range of loans, from business financing to mortgages. In theory, the gap between the prime lending rate and the MPR suggests banks are offering a relative cushion to top-tier borrowers. In practice, however, rates vary widely across the sector, with some institutions charging far above the average. This divergence, set against falling bank borrowings from the CBN, rising deposits, and mounting loan defaults, raises pressing questions about the true cost of credit, the health of real sector lending, and the options available, especially for smaller businesses locked out of prime rate access. Stanley, Onuorah, economic analyst, and Itoro, Nehemiah, investment banker, Parthian partners, join me for more on this. Thank you, gentlemen, for joining me today. Thank you for joining me today.
It's good to be here. Good morning.
All right. Good morning to you, to Itoro, and thank you also for joining me, Stanley.
Good morning.
Good morning to you too. Now, talk to us. Let me begin with you, Itoro. What does an average prime lending rate of 18.19% mean for businesses and productivity in Nigeria?
So in simple terms, it means that businesses face higher costs of capital. So as you mentioned earlier on, prime lending rates are the rates reserved for the most credit-worthy customers. So we're talking about, blue chip companies, large corporates, the works. But we understand that Nigeria's economy is mostly driven by SMEs, right? And these companies would face much higher lending rates, 30%, around 30% and above. And this would significantly affect their profitability margins, right? In terms of how it affects their profits. It will also affect their ability to leverage credit to grow and expand their businesses in the short to mid term, right? Because of the cost of that capital.
Right. Let me come to you. Onuorah, what are your thoughts on this? Apart from the fact that we have prime lending rates, we have the maximum lending rate, and of course, you want to look at the fact that prime lending rate is actually for some set of people, while the maximum lending rate is for some other set of people. But just a thought, though, would you say banks are being magnanimous with this average rate? Because, we know that the benchmark lending rate, that's the MPR, is at 27.50%. So if we have a situation where banks are, lending to big corporations at lesser percentage, and all of those. But I think we'll just go on a very short break now. When we come back, we'll continue. Glad to know you're still with us. And I have right here with me Stanley, Onuorah, economic analyst, and Itoro, Nehemiah, investment banker at Parthian Partners. Thank you, gentlemen, for staying with me.
It's good to be here.
Thank you.
All right, Mr. Onuorah, before we went on that timeout, I was asking you what your thought is about the fact that, when you look at the prime lending rate, it's 18.19%. And then when you look at the MPR, it's 27.50%. Then the maximum lending rate can be as high as the heavens, Does it seem to you like the banks are somehow being magnanimous with this prime lending rate?
So just like he mentioned, the prime lending rates for most of your blue chip customers gives you a feel as they are low risk. And it's not necessarily that they are being magnanimous. They are looking at these are people that their default rate is near zero. So, and for them to have interest rates as high as double digits at over 18%, it gives you a feel as of what the whole macro is for most businesses in Nigeria. So for the banks, looking at what their cost of funds are and looking at their risk appetite, it's not being magnanimous. They've done their math, and this seems like the best that they can offer. If the best you can offer to businesses that have the most creditworthiness is at 18.19%, it tells you a lot about what is happening to other businesses that are small and medium-scale enterprises within the country.
Exactly. I think we'll come to that. But before that, I also want us to look at the fact that while some banks, the prime lending rate we're talking about the average is 18.19, we also know that some banks, they charge as high as 30%. Could you talk to us about what drives such wide disparities, across these institutions? Itoro, let me get your thoughts on this. Why do we have that sort of disparity?
So I'll say there are about two things to look at where that's concerned. First of all, will be risk-based pricing. So you find that some banks who are more attuned or who focus more on the SME market, their average lending rates are going to be much higher than the banks who primarily address the corporates and the blue chips. And the other thing to look at would be what their cost of fund, what their source of funding is, and their deposit mix. Some banks are able to, penetrate the retail market and garner significant deposits, and so as a result of that, have low cost of funds. Other banks, for example, tap multiple sources, right? Apart from the deposits that they have, we've seen some banks approach the market, raise commercial papers and the like, and some banks also borrow from the CBN. Now with MPR where it is and the asymmetric corridor where it is, and then with average rates on the commercial paper space today, I think between 23-25%, I think for most of the banks that have raised in the recent past. With cost of funding that high, they wouldn't be able to, say, match some of these other banks who rely primarily on retail deposits to drive their lending. So, for example, if a bank's cost of funds, like the deposits or the funds that will be used to create this loan assets are in 20s, 24s, it wouldn't make any economic sense to then give out or create loans at rates below that. So those are some of the things to look at. That's beyond the risk-based pricing for the clients that they're facing. The other thing to look at is what the cost of funds is and what their deposit mix is that they're using to create those loan assets.
Right, let me come to you, Mr. Onuorah now. We have a recent report that indicates that banks borrowing from the CBN has reduced significantly while deposits have grown. I mean, this points to robust capital and stability in the financial services sector. But can't we say this has in any way impacted banks' lending or banks' ability to lend to the real sector? Or are they just putting money away in a safe space where they can make much more money for their shareholders and investors?
So, primarily, the banks are in the business of trying to make as much profit for shareholders as possible. But most importantly, what you have seen is an aversion to risk. That's what you're seeing amongst most banks, with rising NPL across most of the banks. The banks are becoming more cautious. So why would I take my money? Why would I take 1 billion, 10 billion and lend to MSMEs and risk defaults when I have a higher NPL, when I'm having my NPL rising, as opposed to taking that money and putting it into instruments that will yield money, or just keep it as a form of risk aversion, or find as many customers that I feel that I could give it to at the least interest rate to be on the safer side. That is what the play that most banks have going for them at the moment. So what we're seeing with the CBN is that we're seeing a lot more liquidity that is at play. But is it impacting the real sector, which is where the economic drivers are supposed to be? We're not seeing that happening within the real sector because most of these manufacturers cannot afford to have this amount of high interest rates for their businesses. So that's why mostly you're seeing a lot more of that liquidity within the CBN.
Right. Let me come to you now, Itoro. I mean, we're beginning to see some trends as a result of this. On the one hand, we saw a report that talked about companies going to the capital markets to raise funds, whether you want to look at CPs. And then on the other hand, just like Onuorah was talking about the NPL, non-performing loan ratio of banks, about 11 banks now, gets to the point where they have crossed the threshold. And not only that, we also saw a report that also alluded to the fact that a lot of these borrowers are already defaulting and they cannot repay their loans. I mean, looking at all of these, what do you have to say to them?
All right, so I guess I'll start from the bit you talked about the companies approaching the capital markets to raise funds. And yes, I think it's an interesting development. Even though the capital market is not one that most MSMEs have access to, but we've seen a surge in that. I think, and one of the reasons why we're seeing that is because capital markets can offer rates that are below the average bank lending rates. I think we've seen rates between 20, 25, 27 in some cases percent. And commercial papers, last I checked, stood at outstanding value stood at 1.5 trillion, which is really good for the capital market space. On the other hand, you talk about the NPL, and I think I read a report not too long ago that talked about 11 banks crossing the 5% threshold of the CBN, even though the CBN had remarked that this was largely due to some proper adjustments were due to accounting. But what we've seen is that what we see is that as interest rates increase, borrowing costs also increase, and that leads to strained loan performance, apart from making some credit inaccessible to certain businesses. But however, I think the overall health of the banking industry remains stable and supported by strong capital buffers and liquidity positions. So, for example, we've seen the impact of some of the quick returns on the recapitalization exercise in the banking industry, with capital adequacy ratio going from 10.81% to about 15.55% year-on-year between April last year and April this year. We've seen liquidity also, grow a bit. I think about 55.4%. One of the other things that is interesting to note actually is that credit to the economy has expanded by about 10.89% as well. So despite the economic headwinds, we're seeing that the finance sector, or the banking sector, is still resilient in light of all of that.
That's interesting. Now, for smaller businesses, without the clout to secure prime rates, how effective would you say development finance institutions or microfinance institutions or even cooperatives have been in filling this particular gap? Because, prime lending rates, we're talking about the big corporations that have proven to be creditworthy over time. What about the smaller ones? Are there alternatives for them? Mr. Onuorah, let me get your thoughts on that.
Okay. For most of the MSMEs, you are seeing them. That's why we are seeing a lot of defaults in the system, because they have the highest defaults from when you look at most of those reports, because they are struggling. They are the ones that are faced with the most of the headwinds. They are the ones that are faced with most of the need for them to raise capital for a few things, working capital, capital expenditure within their small framework, and then they need to have that uptick. So when you start to see microfinance banks do crowdfunding or find sources of funds that would help them to reduce the rate at which they lend to some of these people, they try to bridge that gap, but it's still insufficient, still very insufficient, because most of the guys, so say for example, the Bank of Industry, Development Finance, DBN, and the Development Bank of Nigeria, and a host of other development finance institutions, not everyone can access them. So for the ones that meet this top gap at where they are mostly microfinance banks and some of the cooperatives that most of these MSMEs are known to go to for, to source funding. But still for them, the tenure is short, and then the cost normally for the interest that are given to them are normally very short term. And that's where you tend to see a lot of default. And then some of them do not even have the proper structure to even borrow from banks in that short term. So it's a lot more challenging for MSMEs at the moment in the country as a whole.
Well, that's quite interesting, or maybe not interesting. Are there really alternatives to bank loans that businesses can actually latch on so they can stay afloat? Because we just read a report this morning about some companies that are already distressed. And even though, their loan books, it's not like they are getting more loans, but, they are having the cost of finance is becoming more expensive. And we know that this cannot continue for too long. How do we get out of this, Itoro?
So I think there are a number of ways to look at it, right? In terms of cost of funding, cost of growth, there are alternatives to, or there could be some alternatives to bank loans, even though most of them would be limited, and I think a lot of them would largely depend on the networks or associations or groups that these SMEs are connected to. So, for example, cooperative-backed or cooperative-led loans could go some way in de-risking the facilities from the bank. So imagine if rather than going as one single entity to the bank to get credit, it's a cooperative that comes together and approaches the bank. It significantly de-risks that project and could lead to better loans, or maybe not prime rate loans, but like much better than the maximum loans that the SMEs would typically have access to. And I think crowdfunding may also be another way to go. I see that the retail investing space in Nigeria is one that has been growing steadily in the last couple of years. I know that a couple of crowdfunding platforms have been licensed by the Securities Exchange Commission to go ahead with crowdfunding to invest in certain projects. I think that's another alternative that could be explored. But again, I know a lot of these alternatives would largely depend on the networks and I would say the trust within the space that these MSMEs exist in.
All right, still with you, Itoro. I mean, we understand the prime lending rates and maximum lending rates are sort of influenced by the MPR and other monetary tools. But in reality, much of Nigeria's inflation is cost-push, driven by persistent exchange rate volatility, insecurity-induced food shortages, high energy prices, logistics inefficiencies, structural constraints, a lot of things. And I mean, aren't these things beyond the reach of conventional monetary tightening tools? Because that's what we've been saying so far. But I don't think that will move the needle. What do we need to do moving forward? Do we continue with the monetary tools, tightening and all of those, while the structural issues are not necessarily getting the needed attention?
So I recall certain conversations we had around this around the beginning of the CBN governor's tenure. I recall that one of the things he had clearly stated was that the CBN was going to focus on its core role of monetary policy and not really be as active in the developmental finance space as it used to be under the previous regime. And I think he basically made it clear, that's the CBN government made it clear that this is what they're going to be focused on. And so I guess they're doing what they're able to do, even though what that implied was that we then had a system that had, system of typically when you try to motivate someone, you could have a carrot or stick approach, right? And the monetary policy was the stick. The developmental finance interventions that the CBN had used to do would have been the carrot. But then we then have a regime that says they would focus solely on their primary responsibility of monetary policy. And so that sort of takes away the carrot from the purview of the CBN. And I think in some of those conversations we had in the early days, the question was, there are other agencies, there are other ministries that are tasked with developmental interventions in these key areas that you have mentioned, but we face challenges. So things around, agriculture, food stability, infrastructure. We have these agencies in place to cater to that. I think that a lot of focus has been on what the CBN has been doing. And I think one of the things that Nigerians need to do, in addition to keeping that focus on what CBN has been doing, is also to apply some of that focus to these other agencies, these other parastatals that have been tasked with interventions.
Itoro, let me come in here. You're saying that we're focusing on what the monetary authority is doing, but that seems to be the one that is, out there talking to us. Is the fiscal authority doing much? Because if they were doing much, Nigerians won't talk about it. The only thing we know right now is that there is a tax reform act, or there is this tax reform that, we will kick in from January 2026. We all have to wait till 2026. While people go hungry, while companies fold up, while companies cannot afford to pay their loans and banks are having more NPLs. Is that what you want us to do?
I hear you. What I'm saying is that the same way we're asking these questions of the CBN and of both monetary and fiscal policy, we need to ask these same questions of these other agencies tasked with development interventions. For example, what's the Ministry of Agriculture doing with respect to food insecurity? Because our inflation, which, as you mentioned, cost push, one of the things that one of the key drivers of that inflation has been food inflation. Right? So the question is, CBN is not going to start farms, for example. Yes, the CBN used to do had some developmental interventions or finance interventions for the agricultural space. But I'm saying that the Ministry of Agriculture exists for a reason, primarily to focus on that. So I'm saying that yes, what the CBN is doing has adverse effects. That's clear, and I don't think anyone can deny that. What I'm saying is that and that's the stick part of the conversation. I'm saying that the cow part of the conversation, which is where the interventions that are needful, that need to happen, we need to be asking the questions of the various ministries tasked with delivering those interventions.
All right, thank you so much. And just before we go, let me get your thoughts on this, Mr. Onuorah. I mean, I guess single-digit lending rates have become, some impossibility in Nigeria. How soon do you think we can get there? Is it even possible in the next 2-3 years?
So we just like Itoro had mentioned, we need to get the basics in check. We need to bring down inflation. We need to get our infrastructure right. We need to try as much as possible to pump more oil and have that stabilized within the market. We need to, as much as possible, put these basics in place. When we start to see them, then we now start to see the multiplier effect come down to once inflation is reduced, you start to see a downward trend in MPR, and then we start to see where we can come down to the near figures of say 15 as opposed to where we are at 27. Well, but for the near term, and I do not see that coming down. So we are still optimistic on what the CBN is doing in as much as possible, trying within their means what they have at what disposal with everything that they have to bring down the interest rates. But for the near term, medium to near term, we do not see the interest rates coming down.
And what happens to, companies? What happens to firms? What happens to businesses? That's a rhetorical question. Thank you so much, Stanley Onuorah, economic analyst, for your time on the show today.